Welcome friends, today we are going to learn bonds payable accounting in FAR. Company issues bonds to borrow money from market. Bonds may be issued at discount or premium. It depends upon market interest rate when bonds are listed. So when market interest rate is higher than your bonds, company issues bonds at discount to attract investors. Same way if market interest rate is lower than your bond's stated interest rate, then company can collect premium from the investors because company is paying higher interest than the market. On January 1, 2024, ABC Company issued bonds and received proceeds $92,418 for $100,000 face amount, having 8% interest rate. Market interest rate is 10%. Answer the following questions. To answer all the questions, we need to create amortization table like this. We will book interest expense on carrying amount of the bond each year, and actual interest will be paid on face value of the bond. For first year, carrying amount will be the issue proceeds received $92,418. Now we will book interest expense at market interest rate on carrying amount as shown in table. 10% of $92,418 will be the first year interest expense. Company pays actual interest at actual or stated interest rate of 8% on the face value of the bonds, that means $100,000. So now difference between the two, interest at market rate on carrying amount and actual interest amount paid, is amortization. Discount amortization of $1,242 will be added to carrying amount of bonds, and in this way carrying amount of bonds will reach to its face value of $100,000 at the end of the period. So finally company will pay $100,000 to the bond holders. You can see balance sheet disclosure in which carrying amount less discount is shown. Each year discount will be amortized and reduced, and carrying amount of bonds payable will increase and reach to face value $100,000. You can see the journal entries besides the table. First entry will be the issuance of bonds. Bank account debit $92,418 and discount on bonds is debited with $7,582, and bonds payable will be credited with $100,000. So our liability is $100,000 only. Each year we pass entry of interest expense, which is at market interest rate and on carrying amount. In this case, first year interest expense is debited with $9,242 and company is paying only $8,000 interest, which is actual interest rate on face value. Like this, each year we book interest expense at 10% as shown in table and pays actual interest $8,000, and difference is credited to discount on bonds. Finally, at the end of period we pay back $100,000 as shown in third entry. Let's take example of bonds issued at premium. So when market interest is lower than the stated interest rate of bonds, then bonds will be issued at premium. On January 1, 2024, ABC Company issued bonds and received proceeds $108,425 for $100,000 face amount, 8% bonds, and market interest rate is 6%. Answer the following questions. Again, we prepare amortization table. Now our carrying amount is face value plus premium, so it is $108,425. We will book interest expense at market interest rate of 6% on carrying amount each year. So first year 6% of $108,425 is $6,506. Actual interest payment is $8,000. The difference between two is $1,495 is the premium amortization for the first year, which will be deducted from the carrying amount of bonds. In this way carrying amount of bonds will reach to its face value of $100,000. See the balance sheet disclosure with premium. Each year premium will be reduced and carrying amount of bonds payable will reach to its face value. See the journal entries now. First entry: when bonds are issued at premium, bank account is debited with $108,425. Premium on bonds credited with $8,425. Bonds payable is credited with $100,000. Because final liability of bonds is $100,000 only. Now each year we pass entry of interest expenses given in amortization table. Actual interest payment is $8,000 only, which is 8% on face value $100,000. Difference between the two will be debited to premium on bonds as amortization. In this way each year entries are passed. Finally, at the time of maturity, company will repay the bonds payable amount, which is its face value $100,000 as shown in third entry. Third type of question is when in question, amount of premium or discount is not given or issue proceeds received from bonds is not given. At that time they ask fair value of bonds or issue amount of the bonds. So we need to calculate fair value or issue amount of bonds. So to calculate that, we need to convert all the future cash flows to present using present value factor. Present value factor is always based on market interest rate, which is 6%. Now there are two types of cash flows. First is annual cash outflow of interest payment, which is $8,000 per year up till 5 years, and second is terminal cash outflow of $100,000, which is after 5 years. So to convert annual cash flow, we use present annuity factor for 5 years at the rate of 6%, and to convert terminal cash flow, we will use only present value factor of 5th year at the rate of 6% market interest rate. It is already provided in this. You can pause the video and see the calculations. Present value of annual cash flow is $33,699. Present value of terminal cash flow is $74,726. So total of both will be the fair value of bonds $108,425.
Thanks for watching video. If you like the video, then hit the like button and subscribe to my channel. Bye bye for now.